An explanation of banking related to money and credit. A mystery exists throughout the world's financial banking system. We can find more than 30,000 different banks all over the globe, and between them, they control an incredible amount of assets. The top 10 banks in the United States are responsible for around $25 trillion. Banking may seem to be quite complicated in today's world, yet its initial purpose was to streamline everyday living. In the 11th century, Italy served as the commercial hub of all Europe. However, there was a problem. Too many currencies were in circulation at the time. Merchants from all over the continent gathered together to exchange their wares. Merchants in Pisa had to deal with 7 different coins and swap their money continually. This required them to trade their money regularly. The term bank, which comes from the Italian word banco, which translates to bench, originates from the traditional practice of conducting financial transactions on outdoor benches. People began to reflect on their lives due to the risks associated with traveling, the prevalence of counterfeit money, and the difficulty of obtaining loans. It was time to transition to a new form of doing business. Therefore, real estate agents began extending loans to business people, while retailers in Geneva established cashless payment systems. Banking networks established across Europe extended loans to various entities, including the church and European monarchs. What about the day of the week? Banks are in the risk management business to give it the bare minimum. This is a condensed and streamlined explanation of how it works. People put their money in banks to earn a little bit of interest on it now and then. The bank then lends this money out at higher than average interest rates. It is necessary to consider the possibility that some of the creditors won't pay back their loans. This process is critical to the functioning of our economic system because it enables individuals to acquire assets such as homes and enables companies to develop and expand their operations. Therefore, banks convert the monies that individuals save but do not utilize into money that society may use for various purposes. A bank's other sources of revenue include the acceptance of savings deposits, the business of issuing credit cards, the business of buying and selling currencies, the business of providing custodial services, and the provision of cash management services. The most significant issue confronting financial institutions in the modern day is that many have forsaken their normal function as suppliers of long-term economic goods in favor for short-term profits that are subject to significantly increased levels of risk. During the time known as the financial boom, most significant banks utilized complex financial models that were difficult to understand. They engaged in their trading activities as a routine to generate large sums of money quickly and award their executives and traders with multi-million-dollar bonuses. This amounted to little more than gambling and was harmful to economies and communities. Such as in 2008, financial institutions such as Lehman Brothers extended loans to almost everyone who wanted to purchase a home, putting the bank in a situation where it was exposed to an exceptionally high level of risk. This led to the collapse of the housing market in the United States and portions of Europe, which in turn caused stock prices to plunge, ultimately leading to a worldwide banking crisis and one of the most significant financial disasters in the history of the world. The missing funds are estimated to be hundreds of billions of dollars, cost millions of people their jobs, and at a significant amount of money. Because of this, most of the world's top banks had to pay penalties totaling billions of dollars, and banking became one of the least trusted professions. To prevent the financial institutions from failing and going bankrupt, the United States of America and the European Union governments were forced to put up massive rescue plans. They implemented new laws to manage the banking industry and mandated mandatory bank emergency reserves to mitigate the effects of shocks if there were another financial crisis. However, the banking lobby succeeded in stopping other pieces of the stringent new law. In today's world, alternative money delivery methods are quickly becoming the norm, such as new investment banks that charge an annual fee but do not get commissions on sales. This gives them the incentive to behave in the customer's best interest since they are not financially motivated to do otherwise, or credit unions, which are cooperative organizations that were founded in the 19th century to avoid being preyed upon by loan sharks. In a word, they provide the same financial services as banks, but their primary goal is to maximize shared benefit rather than personal profit. As As stated in the mission statement, the objective is to facilitate the creation of possibilities for members, such as the launch of small enterprises, the expansion of farms, or the construction of family homes, all while contributing financially to the local community. Their democratic board of directors is democratically elected by the members, who also exercise authority over the organization. Credit unions may have a few members or as many as hundreds of thousands of members and several $billion in assets, depending on the organization's size. Across the globe, credit union systems exhibit a broad range of diversity. Credit unions' priority on providing benefits for their members affects the amount of risk they are prepared to assume. This helps to explain why credit unions, although also suffering, fared far better than conventional banks during the most recent financial crisis. It is essential not to overlook the meteoric rise of crowdfunding in recent years. In addition to making it possible to create fantastic video games, platforms emerged that allowed individuals to acquire loans from vast groups of small investors, so avoiding the role of the bank as the middleman in the transaction. However, it is also effective for industry, as seen by the many new technological businesses that got their start on either Kickstarter or Indiegogo. The person who provides funds is rewarded with the sense of accomplishment that comes with being a part of something larger, and they also have the opportunity to invest in concepts that resonate with them, while dispersing the risks across such a large area. If the project is unsuccessful, only a tiny amount of harm would be caused. And last, but certainly not least, there are microcredits. Individuals in developing nations get a multitude of minimal loans, most of which are distributed to assist people in overcoming poverty. People who were previously unable to access the money they needed to establish a company because it was determined that they were not worth the time to invest in them. These days, the provision of microcredits have developed into a company worth multi-billions of dollars. Therefore, it is possible that banking is not your cup of tea. Nonetheless, providing financial resources to individuals and companies is an essential function of our society and must be carried out. However, we get to select who will do it and how they will do it in the future. Both of these things are up to us. I hope you liked and learned something from today's video. If you want to keep improving and being inspired, subscribe and press the bell button to be alerted whenever we upload a video. This has been Market Profits Institute.